I did the math at the beginning of this year, and we're about to pay insurance companies $27,000 in 2026 in insurance premiums. Now, I'm a licensed agent, I work in insurance, and I know how to get cheaper, good insurance, and I'm still paying half the median US income in just insurance premiums. Real quick, this is how it breaks down, and I was so surprised it got me thinking there's gotta be a better way, right? I'm betting you've had similar thoughts before. It's so much money that we're paying to insurance companies. If we just put that into a stock portfolio instead, that's what insurance companies are doing with our money, anyways, right? And I keep seeing reels where street price for medical services are cheaper than with insurance, anyways. What are we doing here? What we're actually doing is stumbling on the little known secret of the inner workings of the insurance world. There's a whole term for this concept, and for the right person or people, it could be a way out of skyrocketing premiums. We're going to cover what it is, how much money you could save, and the different ways you could do it if you're the right person for it. Part 1, Self Insurance. The insurance industry term for what we're talking about is non imaginatively called self insurance. It's when you choose to not opt for third party carrier led insurance and instead just cover the risks out of pocket. Well, that just kind of sounds like not buying insurance, right? Why would you give that a different name? When you self insure, you have a plan to cover expected risks. If you're just foregoing insurance because you can't afford it, that's being uninsured and unprotected. It's a small but important distinction, but also one that people don't generally actually have the choice in making. Every day, due to the increased chance and severity of risks, especially in the state of California, the ability to cover losses is slipping away from more and more people, even with insurance. We can blame insurance companies, and as a general public, we do, but behind the beast is math and statistics that are unchangeable. It's not the insurance company's fault the economy got pumped full of money, and it's not their fault that climate change brings climate disaster. Directly, anyway. Part 2, how much can self insurance save? The premium revenue that an insurance company collects from a policyholder doesn't all go to insurance company profit. In the case of auto and home insurance, very little of it actually makes it all the way down the P&L. The percentage that gets paid back to policyholders in the form of claims paid is referred to as loss ratio by insurance company. This is probably another reason why consumers have a negative view on insurance companies. They should just call that something else. To have your primary function as an insurer, which is to protect your policyholders from risk, to have that be universally referred to within industry as a loss, you would just have to assume what their real priorities are, right? Okay, but back to loss ratios. On average, they range from 50 to 70% depending on the type of insurance. So that 27,000 that I'm paying each year, over a long enough time period, I'm expected to get back in value from those claims, either through a car accident, doctor's visits, or surgery, around 13 to 17,000 or so. So then what's going on with the other 10,000? It might seem like you can save 30 to 50% on your insurance by self-insuring, but this is not really the case, because outside of the cost of claims are the administrative and legal costs to execute your plan that don't entirely go away. Let's say you're in a car accident and the other car tries to sue you. The legal cost of defending your claim isn't included in the loss ratio. Negotiating prices with hospitals or pharmaceutical companies would be labor you'd either have to contract out or do yourself. Investigating fraud by the people you'd have performing services for you, either doctors and offices or car repair shops, that's another thing you'd have to do yourself or contract out. And because of the economies of scale that insurance companies have in performing these functions over and over again versus individuals newly attempting them each time, arguably insurance companies could end up paying less than we would on our own. And that's just the administrative costs of protecting you against risks. How about the chance of catastrophic risk? If you start self insuring at the age of 30 and are one of the few unlucky people to need chemo at the age of 32, you're looking at a bill of hundreds of thousands of dollars with no way to pay it. This problem, however, isn't unique to new self insurers. It's a problem for new insurance companies too, especially when they're starting out. Insurance companies, when they're aware that they're exposed to risks that are greater than the amount that they're able to pay, also take out insurance on their insurance business. In the industry, it's called reinsurance, and it's insurance for insurance companies. As a quick aside, who is your insurance company's favorite insurance company? It's whoever has the biggest pockets, and in the US, that is very often Berkshire Hathaway, the parent company of Geico, and the holding company of recently retired Warren Buffett. Part 3, who gets hurt when the rich self insure? Total self insurance is done by the people with enough money to do it. This means that practically, really only the largest corporations in the world totally self insure. The version of self insurance most people are familiar with is corporate health insurance plans. Something like half the employees in the world have jobs at the top 5,000 companies. They have millions of employees. And to save on health insurance costs, these companies form their own insurance groups and insure themselves within their own company. Let's say Corporation A has 10,000 W 2 employees across the country. Those 10,000 employees that are eligible for benefits will be self contained into their own health insurance plan away from the general public. This saves on insurance costs for the company because it changes the pool of who is insured. Now, the pool of insureds for Corporation A, let's say, are full time employees, mostly professional, often with college or higher degrees, that make higher than average wages. They have better health outcomes. It's amazing for the corporation and the people within it. That's how big companies can offer relatively cheap health plans, even when they're not covering it 100%. However, it's terrible for the rest of the general public. One of the reasons why plans in covered California's public health insurance market, is so expensive is because they're required to cover costs for everyone within the insurance pool. It'd be bad enough if the insurance pool was everybody, but in reality, the insurance pool for public markets is everybody minus millions of full time employed prime working age adults and their families who are covered in their company's group pools. With almost every lobbying dollar being spent by corporations with millions and billions of dollars, I would not expect this to change anytime soon. Also, just in terms of what's fair or not fair, you'd be hard pressed to convince the millions of employees in these plans they should pay more, let alone convincing their respective companies' board of directors that they should pay more. Instead, you end up with something like ACA subsidies, where federal tax dollars, which are everyone's dollars, are paid into the public health insurance market via legislation, indirectly causing everyone to help cover the costs of the public but not actually public healthcare system. How everyday people can self insure. There's two things you need to remember if you're thinking about self insuring. One is only self insure risks that have financial consequences that you can actually afford. And two is you actually need to invest the money that you're saving on premium. So let's think of some lower stakes risks that people can self insure instead of purchasing insurance for. Any extended warranties or insurance you're better off self insuring for. Home warranties are insurance products that you can safely self insure. Getting more risky, you could probably purchase only minimum liability car insurance instead of full coverage and invest the difference. According to Bankrate, it's like $76 average for minimum in California, $260 for full coverage. If you invest the $184 difference using some very, very basic, not entirely accurate math, you're looking at $36,000 at the end of 10 years, assuming you never have to use the bank of invested would-be premium. Also, do not do this. You at least need minimum liability and uninsured, underinsured motorist coverage, not just minimum liability. Pet insurance, if you can find a way to cover the worst case scenario, which is often a $10 to $15,000 surgery, is self-insurable. For a predictable life of 10 years and 7% growth, you could have $26,000 in 10 years to use on emergency surgeries and end-of-life care. If you elect to have a high deductible health plan in combination with a health savings account, that's automatically invested for you. You are participating in self-insurance. And in both the self-insured pet insurance example and the high deductible health plan example, people that take that route often consume less in veterinarian and medical services, which is the only actual repeatable way to lower all insurance costs. You just have to buy less of the stuff. The key for the high deductible health plan, though, is that it's combined with an automatically invested health savings account, because part two is where this whole idea usually falls apart practically. And it's the reason why I don't self insure my pet plans, and I'd rather pay the additional cost to the pet insurance company to not have to think about setting aside the money and investing it. So, can we replace insurance with self insurance? You can't fully replace insurance premiums with self insurance unless you're already really rich. And typically, really rich people actually like insurance because they value freeing up their brain space from thinking about risks. And even most insurance companies can't self insure or can't fully self insure their own insurance books and need some help with reinsurance. What you can do is partially self insure, which is to selectively reduce what insurance products you buy and invest the difference. All the better if it's already automatically done for you, like in a high deductible health plan.